All right. Hello, everyone. Welcome to the May Hangar Talk. Welcome. Thank you so much for showing up live. Appreciate that. It always makes for a more engaging conversation. Hey, Brittany. Hey, TJ. Hey, John.
Hi
You
Hey
know
everyone.
what?
Tate.
The whole team here,
Guys.
man. I think Mark is on as well. Let's make sure that the chat is turned on while I'm doing that. TJ, what's new?
Hey Tate, I am up in Seattle commuting for yet another wonderful trip. So that and talking to investors all day long. So it's a good time.
Amazing. Hey, Tony. Good stuff. Well, thanks for being on, John. Hope all is well in your world. I know you've been working on the secured income fund a bunch while we've been busy with Waypoint. Let's go ahead and kick things off. I wanted to start with a couple of housekeeping items. First off, we've had a wonderful response to our brand new Waypoint Energy Fund, which we're super excited about. We're going to be talking about the performance of Iron Horse and a lot of what's going behind the scenes of Waypoint. Mark's going to jump in here in a few minutes and talk about that. Before we do, wanted to briefly touch on the KYC process. Many of you who have submitted subscriptions for Waypoint Energy may have noticed that you have to scan your driver's license and take a selfie. This is to comply with anti-money laundering and KYC, know your customer compliance laws that we've had to bring in specifically for the Waypoint Energy Fund, as we're planning on that being a very, very large singular fund. So in any case, we appreciate your patience with that. I know it's an extra step you kind of have to jump through, but hopefully it hasn't caused too much consternation, and hopefully that's gone smoothly. Brittany, anything to add on KYC or anything portal related?
Just on the KYC part of it, if there is any issues, for example, if you may have a very common name that may come across, a political person's name as well too, our team gets a notification, and actually Noel, who's on the call, will be reaching out to just confirm those details with you. And if there's anything that does come up, we'll make sure we communicate with you in a timely manner.
Thanks, Brittany. Speaking of Noel, if you want to just say hello, there might be a few people on the call here who haven't had a chance to meet you yet. And Noel is our investor relations coordinator, doing a lot of work behind the scenes, one-on-one with investors, making sure subscription documents are signed correctly, working with IRA custodians, working through, some KYC issues if you have any sort of technical issues. So Noel, if you want to just say a quick hello, that'd be wonderful.
Hi, everyone. I'm so glad to work with all of you and looking forward to working with you more.
Beauty. Thank you. So with that, we kind of wanted to kick things off with performance of Iron Horse. We've had a lot of questions that have come through from our investors on, what's happening. We understand that people are excited about that deal. We had a ton of investment last year, and people are curious, what's happening. So before I turn things over to Mark, I did want to address a couple questions. The first one has to do with, whether we're on track, off track. And, from the very beginning, we said that distributions would start for the Iron Horse deal in Q2 of 27. Excuse me, Q2 of 26, which we are firmly in. So we are right smack dab in the middle of Q2, and distributions are arriving on time. We didn't even start buying well packages on the Iron Horse deal until late October of last year. So we got kind of a late start in 25. We're going to have a much bigger head start in terms of buying well packages for the Waypoint Energy Fund this year. And so we expect distributions to start a little bit earlier next year for our 26 Waypoint Fund. But for Iron Horse, we are on track. Commodity prices are higher than we had planned for. And so Mark can speak a little bit more to that. One other thing I wanted to mention is we've had a lot of questions on break even. And I wanted to clarify a point. We probably should have brought this up in the webinar, but we've had a lot of people reaching out and saying, hey, Iron Horse was targeting break evens in the $35 to $40 range. Waypoint is targeting 50. What gives? I'm going to share my screen, and it's a very, very simple explanation. And that is that we were taking into account the tax benefits when we said break evens last year in the $35 to $40 range. If you look here on our financial model, You can look at the equity multiple, which is essentially, 100,000 in, what does that get you back? And this is our target without the tax benefit. This is our target with the tax benefit. And you can see if you layer in the tax benefit, our break even to get investors above a 1.0 is significantly below $40 and $2 gas. Without it, however, which is how we've underwritten Waypoint, is saying, hey, let's forget about there being a tax component to this whatsoever, and let's just talk about money in versus money out, regardless of what you're getting back from the IRS. And that's what's putting us at that $50 range. So hopefully that clarifies a little bit. Mark can definitely speak a little bit more to the granularity in terms of our underwriting. But I wanted to clear that up because that's definitely been a popular question that's been popping up. Stop share there. Hopefully that makes sense. Mark, I'll turn it over to you to give kind of an update on wells within the Iron Horse Fund and how we're tracking.
Sure. In terms of the last update we gave, there's been a whole lot of changes on the Iron Horse program. Obviously, this one Janet well came online and it's producing about 30% more than was originally projected, which is good. I happen to have a phone call with the operator. I know some people there, and those other 3 wells are online also, and looks like they're going to be producing better than expected also. So they were just a little later coming online. So those distributions or those wells should have come online in February. Just to talk about timing of all this, when we purchase a well, or in this case, Iron Horse purchased a well, sometimes they got drilled immediately, sometimes they didn't. We still have a few wells that looks like they probably got drilled late in the third quarter. And the completion rigs can show up the next month or they can show up 2 or 3 months later. It's all on the schedule. It's a different rig that drills the well and completes the well. After that, once the wells come online, the operators report the data to the state. And then we're after that. So we don't really find out what happened to the wells until the state data starts coming out. And sometimes the operator gives us that information, sometimes they don't. So it's a long process. It looks to me like it's going, as expected. There's been a lot of changes since last time. We've got quite a few wells that have now been drilled and completed. And a lot of them in Oklahoma. I know that was a change from the original data that was given out, but those are all looking to come online here pretty soon as well. And we still got some EOG and CODA wells in North Dakota and Wyoming that we're waiting on information in terms of when they came online. So once these all get online and here, hopefully in a month or two, distributions and cash flow should be significantly above what we just saw in May. That was from one well that was producing 20 to 30% more than projected. So I know it's kind of a slow crawl here, but I've been doing this business for 35 years, and that's very typical.
I think it's also important to understand that the production revenue is from partial December and January, when commodity prices were significantly lower.
Correct.
So that revenue, if you extrapolate that over the 40 wells in the portfolio, we're actually tracking well ahead. And this was always the plan, was distributions are going to start in Q2 of 26. They will ramp as more and more of these wells start paying. It's a process, right? To drill, complete, and then they start producing. The resources are sold, and then it has to work its way through the accounting systems of the operator, and then finally the non-op partners get paid. That tail can sometimes take 6 months,
Correct.
and so it takes time for these wells to come online, start producing, and then for the payments to work its way through the accounting system. But as we fast forward into Q3 of this year, Q4 of this year, I mean, we're going to be screaming on the 2025 fund. We're really
And once
excited
again,
about
it may sound like it's not efficient, but it's a different rig that completes the wells versus drilling. So they kind of like to mow down the field, if you will. Kind of think of it as your yard. They'll move from one location to the next with the drilling rig, and then the same with the completion rig. So they get to it when they get to it, but it's much cheaper for the operators to do it that way because they're literally just moving the rig a couple hundred yards.
Right. Tosh has a good question. Do we still believe Iron Horse will return invested capital within 24 to 36 months as initially projected? Mark, do you want to speak to that?
So far, so good. I would say it's, I mean, from the information we're getting, it's probably a little bit ahead of target, mostly due to the oil pricing, but I don't have any concerns at this point.
Yeah, I would completely concur with that. So very excited at it, on that front. Brittany, was there anything else that we need to touch on Iron Horse before we move on to Waypoint? We just had a question come in. Is it correct to assume the price of oil after completion and at the point of sale is the price of our oil sold, or does the price of oil get locked in earlier in the process?
The differential in the price you pay to transport it and move it is usually locked in by the operators, but the price of the commodity itself, I would say, is almost never done. Companies do have hedging, but that's a financial transaction on their books and does not affect our economics. And as a fund, at this point, we are not hedging any of our projected oil and gas.
Something I wanted to share while we're on, for those of you on your phones, I'm sorry, this is kind of small, but currently WTI crude is above $100 a barrel. When you look out, we've underwritten the Waypoint Energy Fund at 70, and we've got futures above 70 all the way out through March of 29, which we like. We like to see that. We think that the new sort of floor for oil is about $70 a barrel. For those of you who are asking a little bit more granular questions in terms of macroeconomics and talking heads, maybe pontificating on oil coming down into the 40s or 50s, I would say that we're not going to speak to that on this platform today. However, if you remember Schreiner Parker from Rystad Energy, he's going to come back for next month's Hangar Talk in June. We also have an amazing woman named Elena Melchert, who spent 28 years at the U.S. Department of Energy as their research director. She's going to be on the Passive Income Pilots podcast at the end of May. So lots more information in terms of macroeconomics for those of you who are hungry for a little bit more meat in terms of geopolitics and where the price of oil and gas may be headed. This is the futures chart for gas. A lot of people have kind of pushed back and said, well, hey, how come you're underwriting $3.50 gas in Waypoint when I can see that it's $2.80 right now? Well, you got to remember that natural gas is very seasonal. It goes up in the winter and it goes down in the summer because of fluctuations in demand. We believe that there's going to be some smoothing of that because of the AI demand and also because of the export terminals that are coming online on the Gulf Coast. But we feel that 350 gas is very defensible in today's market, and we're bullish on that. Anything to add there, Mark?
Nope, all agreed.
Good stuff. Let's see. Brittany, what else we got?
That was it for in terms of the questions that came in previously for Iron Horse Energy, but Tosh just added in regards to oil prices, what indexes are we using when making pricing forecasts and estimates for both Iron Horse, but also in regards to Waypoint Energy?
Mark?
So the website that Tate just brought up, we can put a link to that in the chat. That's what most people in the industry refer to. It's called CME, and it refers to the NYMEX oil and gas pricing, which is what most people in the U.S. base their pricing on. And
Just
since
drop
all
those
of
in the
our
chat for
yep, since
those of you
all of
interested.
our oil and gas is being sold here locally, that would be the most appropriate price index to look at.
Excellent. Thank you. Let's see, going back to the list of questions that came in beforehand, we kind of addressed the difference in break even. Mark, do you want to talk a little bit, transitioning over to Waypoint, do you want to talk a little bit more about how we've underwritten production on the new
Sure.
fund? Obviously, we've taken great care over many months to get more granular in terms of the underwriting of production. You've taken representative wells, run them through your software. And I mean, on the financial model that we've shared with investors, we have a breakout down to the month of what we're expecting. Obviously, the other part of the equation is pricing, which you can play with on the model. But do you want to talk about the production piece and how we've underwritten Waypoint?
back to Iron Horse just for a second. That was primarily an oil model, and it had a representative oil well, and that's what was used for the whole thing. We decided that we're and they were they said in the beginning that this was primarily going to be an oil fund, probably with some gas wells in it. They ended up picking up a few gas wells now that the final list has come out, but it's still, I would say, more of an oil fund than a gas fund. One of the things we decided going forward is that we were going to try and target, probably an equal amount of gas and oil wells. And in the beginning, probably we're going to go for more gas wells than oil wells just because the price is a little more stable. We felt like it would be easier to get a deal done. And so far, that is what we assumed has been correct. And that's kind of where we are right now. But in terms of the model, I built the model based on two actual deals that one that came into Iron Horse, an oil well deal, and a gas well deal that we got earlier in the year that we've bid on. So these were real situations with real operators where everything was spelled out, all the taxes were modeled, the timing was, I think, realistic. And so that's what went into our fund model, along with some various pricing scenarios. So those are real wells with real taxes, ad valorem, severance, operating expenses, production coming online, kind of in the same delay that we see right now, where, like, for example, the one that we just bid on is going to be drilled in May and it's looking to come online in November. So it'll be, distributions in January or February, just like we're talking now. And just to refer, some of the stuff we picked up in Iron Horse last year had already been drilled. And so
That's
it's not
true.
like we spent money on it and then they hurried up and drilled it and completed it. We got access to some deals that we were still allowed to do, I guess, by tax code, since they had been drilled that year. But I think one of them had already started producing by the time we bought it. So it's not that we're doing anything different this year, other than we're looking to get access to deals a lot earlier so that we can be a lot more selective.
IM has a question for you, Mark. Have you looked into forced pooling states to scoop up mineral rights once drilling is announced in a desired area so you can negotiate a better deal?
So yes, and that's exactly why we're looking to bring the landman on, because they've got a network that will be able to bring those deals to us.
Yeah, we're talking about bringing on a full-time landman potentially in the next 2 to 4 weeks. So very excited about that. But in the meantime, working with various third-party contractor landmen. Julie is asking, and this is a great question, Julie. We are going to have another webinar as soon as next week, prior to the 10% discount expiring, that goes on a bit more of a deep dive on this GP liability concern. So Julie's asking, hey, I'm new to oil and gas investing, concerned about the liability of being a GP, even though I desire the tax write-off. Yet what comes with the liability until we convert to LP? So can we speak more to what can go wrong and how it can impact you personally? Completely understand this. And the unlimited liability exposure, it can be very scary when you first look at it. I'll speak briefly to this. So if you are investing in the oil and gas space and you're investing in a specific well and you have exposure to 100% of it, you're much more exposed. So one of the reasons why, as Mark just mentioned, that EOG package was too big for us was it was 20% of a well package. We do not want that much for two reasons. One, we want to spread dollars around in order to diversify the risk. We want to have exposure to as many wells as possible within the fund. We're looking at even 2 to 3% positions in some wells. 10%, we aren't legally bound to that 10% number per the documents. However, it is sort of our internal mandate, and that's our target maximum. And the main reason really is liability exposure. So just like you said, everyone who comes into the fund as a GP has unlimited liability for what occurs with a well that's within the fund. Where things start to come into focus, though, is when you extrapolate the size of the fund versus the size of your investment versus how much exposure we have on that one well. So if we assume that, let's say, an EOG well, there's a blowout and there's a tragedy where there are deaths involved and there's a massive lawsuit. First off, I'll mention that EOG is a multi-billion-dollar company. They are They're huge. They carry massive insurance policies, and litigators are really going to go after a deep-pocketed multi-billion-dollar company, not a bunch of accredited investors that own a small non-op working interest. But even in a worst-case scenario, if that settlement went, let's say, $10 million over the insurance for that one well, and we are a 10% working interest owner in that well, then our fund, Waypoint Energy, the fund, would be on the hook for $1 million. We're targeting between a $25 and $50 million fund. And so, you start to put that in perspective. And now let's say you put $100,000 into the fund. This might trickle down to the individual investor to the tune of maybe $1,000. We will always step in front of our investor base as fund managers. So if something like this were to come down the pike, we will have a contingency fund off to the side. You remember Iron Horse had a 5% contingency fund. We're utilizing the same strategy. It's just that we're not putting a label on it. We didn't paint ourselves into a corner to say it has to be exactly 5%, but we will use diligent cash management to ensure that we have contingency funds available for cost overruns or anything that happens like this. Additionally, once wells come online and there's cash flow coming into the portfolio, there's a significant stream of cash flow, which of course could just be, we could take a half month's worth of distributions and just redirect it to something like that. So again, we're going to actually leverage our law firm who wrote the documents for us to really speak through exactly how that GP liability works. Encourage you to show up to that. It'll be recorded as well, and we'll send that out, and that'll be sent out in the next week to 2 weeks, but it'll be prior to that expiration of the 10% discount. So hopefully that puts it into perspective. Gabe's got a good question. Are you finding it harder or more costly to get into wells compared to prior to the Iran situation? Are operators leaning to keeping the wells for themselves given the WTI price?
Well, for about a week or two there during the war, I didn't get any deals come in. So I think everybody was waiting for a little while. The deals are back on the market. I would say there's probably more gas deals than oil deals right now. But since we've only won one bid and signed up and looks like we're going to get another one or two, that's not enough data points to know if it's going to cost more or less. We're just going to have to wait and see. But at least the deal flow is still there, which is good. That means everybody's not just sitting on them. But
Right.
I think it still looks like business as usual.
Excellent. I am saying it would be helpful to get an updated production timing projection for Iron Horse 2020 in 2026, so we can plan for the IDCs needed and the size of the Waypoint investment. I am very sympathetic to that. It's difficult for us to do that right now when half the wells in the Iron Horse portfolio haven't started production and started reporting to the state. We will be up on that, and you will have all the information as quickly as possible as it starts to come online. Mark, I don't know if you want to speak to that. I mean, there really isn't any way that we can get ahead of those projections.
I mean, we could make a prediction. We could make a prediction, but that would be guessing. I mean, we've still got 9 or 10 wells with no information yet, so I wouldn't want to do that. But once they've all come online, we will be able to get a very close estimation of that. I mean, that's what I know how to do, and I've got the software to do it. But I've got to know what initial rates they come online at and what dates they start. Because hopefully they'll all be better than projected. We tried to be conservative, but just the nature of the beast is there's probably going to be a dog well or two in there, and there's a bunch of wells so far that are much better than projected. So you have to have maybe 45 to 60 days of production to be able to nail down a forecast on a well. Once you get that, it's very predictable, but you just got to see where it comes online. You got to make sure the wells aren't being held back, which some operators do. Sometimes you'll have an operator bring a gas well online and choke it back about halfway until winter hits.
Right.
These kind of things just happen a lot. So we need to get them online to where we can predict them. But once they're all online, it should be pretty easy.
Follow-up question. Can we expect an estimate by December at least so that people can throttle their
Sure.
follow-on investment into Waypoint to
I
get
I
that
would
tax
hope
benefit?
I would hope much sooner than that. I
Excellent.
had been thinking middle of the summer, maybe late summer.
Sounds great. Matt's got a question about AMT. I would say we will do we've discussed this on the webinar somewhere. AMT is largely gone. So I would say that's a question for your CPA. I would reach out to your tax counsel. We can absolutely give you a redacted K1 from last year so that they can have something to work with, but more than happy to provide that. Good stuff. I wanted to get to another question before we stop the recording and go to open Q&A. Someone was asking about an IRA investing strategy. IRA money into a self-directed IRA, and this is something that comes up a lot nowadays, where you can take that share and go to get a third-party appraisal. So let's say you invest $100,000 into the Wildlight Fellowship Senior Living deal through your self-directed retirement account. You have $100,000 in your cash in your IRA. You invest it in Fellowship Wildlight, and then you would go to a third-party appraiser and you'd get it valued at, let's say, $60,000. You can then do a Roth conversion and only pay taxes on the $60,000 conversion versus the full $100,000. It's a great strategy. Keep in mind, however, that those appraisals aren't cheap. They're $2,000-$3,000 sometimes, and so the juice has to be worth the squeeze. And then the reason I wanted to bring this up is because there's a common misconception that you need to target deals that have significant depreciation losses in order to get the valuation down. That is completely irrelevant and not correct. So your tax basis has nothing to do with the share class valuation. The appraiser is not bringing the value of that share down because of depreciation losses. The appraiser is bringing the value down because of illiquidity, lack of control, and various other factors that they can reasonably appraise the share as less valuable on the secondary market than what you actually put into the deal. The other thing is that these appraisers, we've tried to get them on our podcast. They don't want to come on because they don't want a target on their back. So it is a legitimate strategy, but they kind of like to fly under the radar. But keep in mind that it has nothing to do with your depreciation losses. So this is not a strategy that you would want to use in oil and gas. I just wanted to make that clear. So it's a great strategy if you've got, a $500,000 self-directed IRA and it's all invested in private market alternatives. Reach out to us. We can refer you to a couple of appraisal firms who can help beat up that valuation if you wanted to do a Roth conversion. There's also, we've talked about the strategy that some people have used. It's a little aggressive, but you can invest in the oil and gas deal in order to get your adjusted gross income down and do a Roth conversion in the same year. That can be a strategy that some people employ, which is very effective. So just wanted to touch on that. TJ, did I explain that okay? Did that make sense?
Yeah, it was awesome. Yeah, if anybody has any questions, please feel free to reach out.
Excellent.
And if
Thank
you do employ that strategy and you have an appraisal, we just ask that you share it back with us so that way your fair market value reports that we do send to our custodians reflect that appraisal amount. So it's consistent
Yes.
across the board. What our
Great
documents
call out.
get sent at the end of the year. Yeah.
Yeah, if you don't have, most people don't end up getting this done. We're required by law to send out fair market value reports to your IRA custodian at the end of the year. If you have an IRA, if you're investing with cash, this doesn't apply to you. And we typically use, if you invested 50K, we just say it's worth 50K. We don't adjust it up and down based on market fluctuations or anything like that. It's just worth 50K until the day we exit and we give you, money back plus profits. So if you do get the valuation, like Brittany said, let us know so that we don't tell your custodian that it's still worth 100 when you have an appraisal that says that it's worth 60. So good call out. Any other questions that we wanted to kind of address before we finished up the recording?
Buddy bidding, if you wouldn't mind. I just added that note. There's a question and somebody just added it in the chat around buddy bidding. How does it work? How does it work in the investment process? And is it available for all investors and or all investments?
So, Brittany, this is your brainchild. So why don't you bring us through it?
I was trying to play host, but happy to explain it. So buddy bidding is our referral program where you as an investor club member with us are able to, bypass the minimum investment amount if you bid or invest with a fellow investor or a fellow pilot. They have to be accredited, as all of our deals are open for accredited investors only. But this allows us to, one, expand the opportunities to other investors, introduce them to Turbine Capital, but to allow you to be under the minimum. Because we have minimum investment placed in for all of our deals, you would have to email investors@turbinecap.com introducing us with that person you wish to invest in, because as Noelle is on here, she will be manually recording the investment, as investors can't do that below minimum at the moment. So we will manually record it, tee up all your documents, get you set up, introduce your buddy bidder to TJ to ensure that they know the process of investing as well too. And then we'll kind of take it from there. It is available to all of our investors. Now, I will say that it may not be available on all of our deals, as if you have been here last year, Stealth Point actually was a lower minimum at 35,000, and so was Miticus. So there are deals that we lower the minimum overall for all investors. But as of now, all of the deals that you see open on the dashboard has a buddy bid option available. But if you have any questions, as always, you can email us, investors@turbinecap.com.
Thanks, Brittany. And I will just clarify that this is a referral program. So it has to be, your buddy bidder has to be somebody who has not invested with Turbine before. It has to be a new referral. So that's sort of the give and take there is, hey, if you want to bring a friend in who has not invested with our group before, more than welcome to, and you can meet that minimum together. I will also say that you're welcome to do this for higher share classes. If you want to invest in Waypoint as a Class B share, it's a $250,000 minimum. If you want to pull in, 4 people who have not invested with us before, and you all come in with 50, we'll honor that. But again, it has to be the individual who you're buddy bidding with has to be someone who does not have an active capital balance with Turbine.
Yes, that is a question we get often, is can I bring in more than one? So yes, you can do as many multiples. Just know that on our end, we see it as separate investors. So your K1s are not linked together. So Tate will never have TJ on his K1. You folks will individually get your own set of legal documents, your own set of K1 tax reporting documents as well too, and have access to all of the same information.
Excellent. Thanks, Brittany.
Thanks.
We should also probably touch on the secured income fund before we stop the recording. So, John, I don't know if you want to come off mute and talk a little bit about the secured income fund.
Absolutely. Yeah, thanks, Tate. We're pretty excited about the secured income fund. This was a deal that kind of came up. We weren't really looking for this. We were talking with ROI Group, which we had originally built a relationship on working with them on a development deal. And so this was last year when we first started talking with them, and really enjoyed getting to know them and seeing their history, and their track record was impeccable. And it didn't work out for us investing with them on a development deal, mostly because we were investing in another development deal with Wildlight. However, Rob with ROI Group said, well, hey, look, I actually have this. I don't know if it's something that you guys could do. And I remember, Tay, when you first saw it, you're like, oh, this is incredible, because the bottom line is it's a 15% paid monthly for 12 to 18 months to our investors. And it's pretty much, looking at like a preferred equity position, loaning it out to ROI for them to begin a development project called Terra Creek. And that was actually one of the deals we were looking at investing in. What's really great about this is with any type of preferred equity or loan, or if you're going to give a hard money loan to somebody, you really want to have good payback options. And with this one, it was not just like a single, double, triple layers of protection here, but we actually have, I think we're at 5 now, Brittany, maybe 6, we'll have to see. But regardless, we feel it's extremely safe for our investors, to where we definitely wanted to put the Turbine name on it and make sure that, because we know that Rob and ROI Group is definitely going to be wanting to pay us out so we can work with them further in the future.
Thanks, John. Yeah, we're excited about it. So there's going to be a pre-recorded. We're not going to do the webinar live. We're going to have a pre-recorded webinar that'll go out late this week or early next. We've gotten some questions on tax benefits with that deal. There are zero tax benefits. So every dollar that you receive of that 15% is going to hit your income as a K1. There's no depreciation losses. For you SDIRA investors, there should be no UBIT implications because there should be no net profit on the project prior to us being refied out. This is very expensive capital for them, and they want us out of the project as quickly as possible. So this equity is coming in so that they can get the project off the ground. And then as soon as they've got things built, they want to refi us out as quickly as possible. There's a chance that there was a chance when we were speaking with them initially that they're like, we might be able to get you out in 6 months. We're like, that isn't going to be worth it for our investors. So it's a minimum of 12, maximum of 18, and they have a one-time automatic extension option to go to 30 months that comes along with a 2-point rate increase. So investors would go from 15 to 17, fully funded interest reserve for 12 months. So we really like the deal. Again, as John was alluding to, we were looking at the development deal initially, and we liked the development deal. It's just that we've done too many development deals in the last few quarters, and we just said we're not really interested in bringing that into our pipeline right now. And they said, well, what would work? And we landed on this. And so in any case, looking forward to it. I'm asking, why are they willing to pay such a high interest rate? Why don't they have better options? Well, this is not debt. You got to remember that this is pref equity. So they needed some additional equity in the project in order to go vertical, in order to get the construction loan. And they have put many millions of dollars into the horizontal infrastructure. They've got roadways built, they've got sewer lines, they've got all the horizontal infrastructure done, but they're just sort of out of money and they need a construction loan. They've got a builder ready to go. Everybody's ready to go. But, Rob is like the classic real estate investor where he's equity rich, cash poor. He's worth $45 million on paper, and but just doesn't have the cash available. And so they're losing money every day not building this project. And so actually for them, this is cheap, being able to pay us in order to, just get the equity in the door, get the construction loan closed and get it built is the cheapest option for them, believe it or not. So as pref equity, can we get any of the depreciation? Yes, if we stay in the deal long enough, but the idea is to get out. So the idea is to get in, get the project built, and get out, not to stay in the deal. We don't want to stay in the deal. We want to get people their return and then get their money back, and we're out. If we are, if they exercise the extension option, maybe. But the problem is, you think, okay, we're in month 18, it's built, they exercise the extension option. Sure, they do a cost seg bonus depreciation. We get depreciation. Let's say that's in February. They sell it in year, or they refi us out in 6 months after that. You're getting the depreciation and the sale in the same calendar year. So it doesn't make sense. So unless you're holding real estate assets for longer than this short period, sometimes it just doesn't make sense to even go down that road of depreciations. This is why we're saying this should not be looked at as a deal with any sort of tax benefit. This is simply, think of it like a super CD. Money goes in, you almost immediately start earning 15%. The clock starts at the time that the equity is sent to the project. We've already soft committed. I mean, we're oversubscribed on soft commits, so it should be pretty much a slam dunk. Interest starts accruing. Monthly payments start 30 days later, and that's going to show up on your K1. You're going to have to pay taxes on it. It should be thought of kind of like a super CD where you're getting 1.25% on your money on a monthly basis. And that's it. We just want to make this really simple for investors. Like we want to make sure that people understand it's monthly income, no tax benefits, highly secured, in and out. Timing for funding, great question. I would say by the end of May, we want to have this capital in the bank because again, the clock starts after the capital is deployed. So that's why we've sort of opened it for soft commit right now, tried to have a big capacitor of people who have been engaged and shown interest. We have oversubscribed via soft commit. So I think that will be pretty quick, but yes, you're saying SDR to IRA takes a little extra time. That's completely fine. we understand that SDIRAs take some time. So, 2 weeks, 3 weeks, but the sooner the better, because we want to get this cash on temperature and wrap things up. Anything I missed there? All right. And before we shut down the recording, I do want to say Waypoint is absolutely off to the races. Mark, I want to kind of circle back with you because we have deals in the hopper. I know that the 10% share price discount doesn't expire until May 31st, but if you're considering investing before May 31st, do us a favor and get those funds in, because we have some incredible deals in the pipeline, and we're hesitant. We've got cash in the bank, but we're hesitant to bid on a couple of them because we're not sure how much capital is going to be coming in on May 30th at that 11th hour. So if you have the intention to invest in the Waypoint Energy deal prior to May 31st, do us a favor, come on in, because the water's warm and we got some great deals in the hopper. So
If I could explain one more time how that works. When we get into a deal, we bid and we give, a promotion, if you want to call it that. So this is an amount that the operator or selling party gets to let us in the well. And that has to be paid right when we bid it. And that's not a great deal, but it is a fair amount of money. After that, once the operator gets notified that we're going to be a partner with them, they can bill us that day for the rest of the money for the drilling of the wells. They can also wait until after the wells are drilled to bill us that amount. So we're on the hook for a lot of money once we sign this deal. And we may get billed for it the next month. We may get billed for it 6 months from now. That is really up to the operator. And we've got to, develop relationships with them. So, we kind of have to set aside a little bit of money that we may need a week or two later or several months later. But it would be, be not good for us to constantly be bidding on things where we don't have money available to do that. We would have a bad reputation, and we don't want that.
excellent. We are extraordinarily excited about the deal. It's going really well, and we have some amazing deals in the hopper. So with that, thank you for those of you who are listening to the recording.